Welcome everyone to the public portion of the November 20th Investor Advisory Committee meeting. I'm Jeff Brickman, and along with the other co-chair, Shani Smith, we're excited to have you all here. Just a quick reminder, all views shared today are people's personal perspectives, not official positions of any firm or the board. Along with our IAC members and board representatives, we're also joined today by an SEC observer, Gaurav Haran Andani. Earlier this afternoon, we discussed market trends and developments that IAC members are observing, which influence work here at the FASB. We also received an update from our technical director, Jack Day, who gave an overview of what we heard in our agenda consultation process. And we further discussed several ongoing projects initiated in response to feedback received during those consultations, including equity method and consolidation. With the help of our IAC members, we're going to recap the morning discussions and hear summaries of the key views expressed. After each summary on a topic, as we've done in previous meetings, you're welcome to add to the discussion by asking questions by pressing the raise hand button. If you have an immediate point to raise, please raise both hands and we'll do our best to call on you right away. And if you could, please remain on mute until it is your turn to speak. So with that, we'll get going. And there was tons of discussion this morning. It was really great. We started off on a broad discussion around technology. There really were two pieces to it. The first half, and David Pizzamente is going to lead us off on, discussed investments by companies in the space and some trends and different issues that the group was seeing. So David.
Thanks, Jeff. A number of members of the group made comments here. Some of them were around the large scale of investments that we're seeing across the technology space. And it involves relationships and transactions between a number of different companies. And some of those involve equity stakes and vendor financing. Also, just with the rapid pace of innovation that we're seeing with these investments, there's some talk about the useful lives of the different types of assets being deployed. One of the other comments another member made was also around accounting for leases and data warehouses, et cetera. So it's quite topical in the markets these days because of that pace and scale of innovation. And others may want to follow up with more specifics on that.
Any other IAC members want to jump in? There were plenty of comments made by a number of members in the group.
I think one of the points that David mentioned is regarding leases. So a lot of the investment is now coming through not only in CapEx, but also in the form of leases, capital leases. And some of our feedback in the past with the lease rule is that we're missing, one of the components missing is the actual life of the asset that's being leased. We do get the remaining contract life, but there's inconsistent or very little disclosure around the actual life of the assets that are being leased. Sometimes we'll say, anywhere between 1 and 20 years, or we lease everything from furniture, to warehouses or whatever. So it's kind of vague. So that becomes more important as more of this investment is done through leasing.
Brad?
Sure. I had a concern regarding these circular transactions that we're seeing be struck between AI participants, and in particular with the valuation of these circular transactions where revenue is being recorded by somebody and then being thrown back to the initiating party in the same amount also being recorded as revenue. And my concern there is the inflation of the value of that revenue. And so that's something I think is very topical amongst investment professionals right now. I've received lots of calls asking about this. So that's something that is extremely topical at the moment.
Thank you for that. Any questions from the board or any others? Any other comments out there? Yeah, Sue.
Yeah, no, I appreciate Ron and Brad's comments on some things that they would, they feel is lacking. I wondered if, related to the first comment about equity stakes, vendor financing, that sort of thing, in these arrangements that they're seeing in technology, whether there's other aspects of transparency that, David, you think are needed, that we should think about?
Yeah, unfortunately, I'm not the best person because it's not my area of expertise or the industries that they follow necessarily. But I think it was related to some of the things that Brad was saying, that I think a lot of investors would like more transparency and have some concern around.
Yeah, I mean, my concern also is that some of these companies are so large that a lot of these deals will fall under the threshold of materiality. And as such, the disclosure around these deals will not be apparent to investors. And lots of times you can obviously go to the other side of the transaction and ask that company or look at their financial filings. But a lot of these companies are private. And so there's no ability to provide a check on that. And so that's the real sticking point here. And I think it goes further into the point about that I've had for a long time about materiality thresholds and disclosure around that, because a lot of times there are things that fall under those thresholds that, in my opinion, should be are very material and should be disclosed.
Yeah, great. And the second half of the technology discussion really focused, and we probably just brushed the surface on the myriad of ways that investors are now using technology and AI to do some of their work, but also a look to maybe some ideas of how we as an organization can look to technology as we move forward to future standard setting. So it's a broad topic, again, a lot of discussion, but Dennis Nevling is going to give us a little bit of an overview of some of that. Dennis?
Yeah, absolutely. Obviously, a broad topic. Committee members discuss the impact from the increased use of AI. That varies very much in terms of the different types of investors that are using AI and the impact that will have. The speed of analysis was mentioned through AI, including footnotes and the analysis on that, and how that potentially has increased the market impact on stocks from accounting filings. The overall view was also that disclosures can be digested much quicker than ever. So complicated topics that now can be further explained really quickly, just make it easier also for a broader set of investors to understand the filing. And then we had some discussion around the impact on accounting and potential changes. I mean, there was one idea of, that would potentially support the idea of standardization of certain KPIs in order to make sure that the right KPIs and right numbers are being taken in that analysis that comes through AI. But again, just scratching the surface. I don't know if other members want to add from our earlier discussion.
Any others want to jump in? And there was definitely a number of other areas too that were touched. Or questions from the board?
Yeah, Jeff, I might just want to add, I appreciated the earlier discussion on how our investor advisors are currently using AI and ways they think it may shape the future. So I look forward to the ongoing discussion in future meetings as that continues to evolve and gives us more information on how we can do our jobs better.
Absolutely. This probably could be a standing topic for all future meetings. So this is the start of many discussions. All right, so moving on to a slightly different topic, we're going to go over to Catherine Mueller on non-depository financial institutions and some ideas around disclosures and what she's seeing in that space.
One topic that we talked about in the financial institution space was we've gone from a period where we've been asking for more disclosures on interest rate sensitivity to all of a sudden very quickly pivoting to needing more disclosures on NDFIs or non-depository financial institutions, given we had a number of larger companies have credit issues in a number of NDFIs this past quarter. Part of the trouble with the disclosures of it is we do get NDFI disclosure in call reports. So there is some base level of disclosures for investors, but the data is it's very broad. Many times there's a category of other that a lot of banks kind of jam most of their disclosure in other, so you're not really sure kind of what's in that category. And NDFI obviously is a very broad category, right? It's private credit funds, BDCs, non-bank lenders, consumer credit, mortgage warehouse. So there's just a lot of encompasses within that and can be a broad range of risk within that too. So one part of our discussion that I thought was interesting is, some of the issues that we had this past quarter were issues of fraud. And so it's really hard. So sometimes no matter the amount of disclosure you can't anticipate fraudulent activity, right? But I still think it was important to note to the board that this is a topic in the financial institutions group that's been very topical. We've been, and I think it's going to continue to increase, and just being prepared to have more and more disclosures on the type of NDFIs that you're lending to, the kind of growth that you're having in that asset class, and then any kind of losses or kind of credit migration that you're having within that group as well is going to be an important thing to follow in the next few quarters.
Thank you for that, Catherine. Anyone else? There's a couple others that chimed in on that as well, or any questions from the board? All right. And then next we'll move over to stablecoins and our project that recently was added to the technical agenda that we've been working on. And we had some views and thoughts from a number of the members in the group on its classification and whether it made sense for some to be considered cash equivalents. And we're going to hand it over to John Helst.
Thanks, Jeff. Yeah, a lot of interesting stuff going on with stable coins, and from my standpoint, the issuers, the largest being Tether, which is, I think, based out of British Virgin Islands, and then you have Circle, which is publicly traded, so we have financial statements for that. 20 times levered at Circle, 30 times rumored to be levered at Tether, so that's versus a bank, which is more about 10 times, which also has FDIC insurance and Fed window access. So the main concern there is liquidity in an event of a run, and or just compliance and regulatory oversight that these companies these are the two biggest issuers by far. Like I think 150 billion and 75 billion, and the next third largest would be 11 billion. So, those are the two big main stablecoin providers. So what you focus on those two, and then what if you have liquidity pressure, then how do they make redemptions in terms of fiat for the stable coin? And the Genius Act mandates that these are in I think US or cash equivalents, right? Like short-term T-bills and or CDs and whatnot. So, but we have to, I think, how is this regulated? It's understood and it's disclosed that BlackRock is managing Circles. So that's trustworthy, but you still want a second set of eyes. And then who's the number 3 and number 4, right? Like you want a uniform kind of controls and compliances, and then investors are going to want, and then also what 90% of the use case of stablecoin right now is to buy Bitcoin, which is then sitting in a custody account at Robinhood and who knows where else, right? Which has had a high failure rate. So you kind of want to understand the whole ecosystem as well as just point in time, like Circle's balance sheet and or whoever the next new stable coin is, right? JP Morgan is talking about getting into it, and then Fiserv is trying to create a community bank stable coin, which all makes sense from a business standpoint, but it's an innovative and fast moving environment.
So John, do you think that all or a subset of this space should be considered a cash equivalent, or do you view them as that?
I mean, in theory, yeah. Like, money market is superior to this to me, but because they have the money market rules and regs, and it's been established out of the Dodd-Frank by the SEC, and it was out of the reserve fund accident, right, which had liquidity concerns. So you don't want another event like that. So I think that's where it should go. I think that's appropriate, but I don't know if I would call it that like today. But yeah, that's where it should go if everything gets finalized and regulated and approved and monitored, if that's fair.
Anybody else have any thoughts, any views, questions?
Sorry, Jeff, I can't
Yeah.
find where to raise my hand. But just with regards to that, John, it sounds like you have more of an openness to more things being cash equivalents than maybe would be under the definition that we have today. And I'm just thinking of it from the standpoint of, or you could have a treasury security, but if it's not due, if it's due in 6 months, it wouldn't be considered to be a cash equivalent. So I'm just trying to balance that, right, as a board member thinking about the emergence of stable coins and how we think about, how we think about direct redemption versus liquidity in the marketplace, and how we think about that with existing instruments under our existing definition. So just curious if that came up at all.
It did, but not the 6-month window, which my understanding is Circle is 30 days or shorter. So, but you could still, 30 days is still 30 days, right? If Bitcoin just totally was eviscerated and everyone wanted their money back, right? You go to Robinhood, you liquidate your account, and then you turn around and try it. And what if Robinhood goes down or something, or whoever, whatever Bitcoin exchange? That's not going to be a good day for Circle, because then they're sitting there like, oh, we thought we were liquid, but now we can't get our stable coins back out of custody. So yeah, I mean, I think the money market reform sort of has it tranched where you can go out so far, but it can't be the whole portfolio, right? So I don't know how, I haven't dug into the Genius Act so much so that you can tranche out probabilistic demands for your money. And then I think what was brought up that I failed to mention was, like, can anyone issue a stable coin? Like what kind of rules and regs do we have around issuer support? And how do we get comfortable with these non-publicly traded, non-Sarbanes-Oxley regulated issuers? That's a very good question. I'm not like a big fan of this. It's just that it's happening. The Genius Act happened, and I'm not saying it should be a cash equivalent today, but I could see why it would make sense. But then you also want to guardrail it like super tight, like make sure that it is what it's supposed to be.
All right, thank you for that. Yeah, so as I mentioned, this is an active project, so we'll be talking to many people, hopefully several of you, on this, and we look forward to more dialogue. Maybe perhaps we'll move on to the equity method discussion, which was the first of 2 topics that are also agenda items that came out of our consultation, that some constituents mentioned to us as areas that could use some improvement. And starting us off on equity method is John DeVita.
Yeah, thanks, Jeff. We talked a bit about the equity method, and the topic was really around if something is deemed worthy of the investment, having a single line consolidation, that having some background or some more disclosures around that in terms of what the revenue and income, and maybe more importantly, the balance sheet side of that, the assets and leverage around that would be important. Using a fair value adjustment led to questions around methodology and sustainability, and most investors would just back that out of the parent P&L anyway. So didn't see a lot of value in just using that fair value adjustment.
Yeah, Brad, did you want to chime in as well?
Yeah, I had, and granted, when you take a step back, this is looking at a very subsect of the overall entities that are being accounted for under the equity method, because it's just those folks that are in the 3 to 5%, the LPs, the LLCs, whatnot. My concern is with fair value and the ability of a company, particularly if the equity investee is a private company, to set a value that may not be congruent with reality. Particularly it's a level 3 type of asset. And so, and particularly if that is being run through the income statement quarterly, obviously there's the ability to manipulate things. And so that was my big key concern. But again, I'll admit that this is just a very small subset of the overall equity investee environment.
Thank you for that, Brad. Anyone else? There was certainly plenty of discussion that I thought John did a great job of capturing the key points, and Brad to add on as well. Any other thoughts or questions from the board?
Yeah, Jeff, it's Rich. Just on Brad's comments, that I appreciate them, and I think we had an ongoing discussion about, in lieu of say a level 3 entity calculated fair value, what about third-party observable transactions? And not to put words into Brad's mouth, but that seemed like better evidence to be changing the value of something with than simply that mark to model.
That's correct. I agree with that.
Any other thoughts or questions? All right, great. And then the final topic was consolidation, and some of that was a little bit of an education session where the team ran through what we're thinking about, but we also had a few thoughts as well. And we'll go back to Brad Rexroad again to kind of lead us off and tell us a few of what we heard. A few things.
Yeah, sure. So we had a discussion about perhaps using a single method for consolidation. We have the VOE, which is a standard method that's been in use for quite a long time. And then in the mid-2000s, the VIE came into existence. And it's the complaint from preparers is that it's a bit cumbersome and complex to have to wade through. And so therefore there was a push for a single use entity. My concern about consolidating some of these VIEs or using a VIE method is that you might end up consolidating something where you only own, or a company only owns, say 3, 4, 5% of it, and they deem that they have influence and control and power over it. And that distorts the income statement because you're going to consolidate 100% of the revenue, the expenses, and yes, the 96% you don't own, it's going to be of the earnings going to be taken out, just above the line, but that's going to also distort things like EBITDA and other metrics that I think the board should take into consideration before kind of going headlong into using a single method.
Great, thanks for that, Brad. Anyone else from the group want to add on it? Any questions? All right, excellent. Well, that was a great discussion. Thank you all. And before we adjourn, I do want to recognize 2 of our members who, unfortunately for us, because they're both amazing, are participating in their last meeting. The first is Heather McPherson, who unfortunately had to drop off the meeting early, but I still will praise her behind her back. She's been an active participant in the group and has helped us build what I really view as kind of a meaningful and strategic relationship between our organization and T. Rowe Price. She's consistently brought additional voices into the building in different ways, both in this meeting, but also in ongoing outreach throughout the year. We've really benefited from perspectives across a wide range of sectors, and she's even brought in very senior level investors and even very senior level management at T. Rowe. So much of that discussion has resulted in, frankly, board discussions around future outreach and future standard setting. And it's really been terrific. So Heather, thank you. Hopefully you'll hear this. If not, I'll give you a ring. But we deeply appreciate your time, thoughtfulness, and the partnership you've helped build, and we'll hope to build on that. The second person who's also terrific is Dennis Neveling. Dennis hails from Lazard, and we've had a long relationship with Lazard, but Dennis really kind of upped the ante in a number of ways. He, even beyond his consumer sector experience, he consistently brought perspectives from colleagues really across his firm. It ensured a diversity of views were heard, and it informed our discussions in many ways. As I mentioned, our relationship with Lazard goes back a long way. Honestly, for me, goes back even well before I even joined the FASB when I was an analyst. But, you know, he leaves very big shoes to fill, and he's already introduced to a friend and a colleague of his who we are speaking with and hope could be a future member. So thank you so much, Dennis. It's been great having you. You're going to be very missed. We do really appreciate the time. For both Dennis and Heather, there's gifts in the mail. If you have not already received them, keep an eye out for them, and thank you. And really just a public service announcement for both the group and for anyone who happens to be listening. You know, we're always looking for more people to add to this group, but also to the outreach process that Shandy and I run at the FASB. We always want new voices. You do not need to be an accounting expert. It's really not the goal. The goal is to learn from capital allocators about how we can provide financial information that best supports their decision making. So if any of you know of anyone, or anyone that's listening is interested or knows of anyone, please do call us. We're always interested in new people and anyone who's interested in participating. So with that, we will be meeting again in May of next year, and then again in November, and we will release those dates when we have them. But we do thank you all for your participation, and we will talk to you again soon.